Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for February 1st, 2021. Please see our disclaimer for important information. Well, here's our latest data from covidtracking.com. As you can see on the blue line, that's a 7-day moving average for daily new positives. You can see that we've kind of moved past that post-holiday peak, if you will, although we do see a continuing rise on a 7-day moving average daily deaths, and that's almost kind of a catch-up from that bubble that we had in new positives, and that typically runs at about a 2 to 3 week lag. And so the hope there is that we'll see that begin to trend down. But the good news is, as we are on the eve of vaccinations, and we've got some data on that. Now that we've got about 25 million vaccines in arms right now, that we'll begin to see a noticeable change in that daily death total. Here's our path to immunity chart, and it comes to us compiled by First Trust Advisors. I think this is going to be an interesting chart to follow in the coming weeks and months because of, I think, the increasing concentration of that green component. I think that's going to be the dominant color as we get into certainly in the middle half of the year here. So just to explain what this represents, the blue line represents the positive U.S. COVID-19 cases. The gray represents what the CDC thinks are the cases that have not been reported, but that are likely to have taken place, basically positive infections that have not been reported for one of a number of reasons, that people just didn't get tested, were asymptomatic and didn't know that they even had it, so on and so forth. And they've kind of ascribed a multiple of the actual positive tests to that. So if you kind of look at this, and then you that orange line that kind of runs through the top of this represents the estimated share of the U.S. population with COVID-19 antibodies, whether they've been vaccinated or they've had it, et cetera. Now, Dr. Fauci and Dr. Michael Osterholm, the University of Minnesota, and some other, immunologists that have spoken on this topic say that this herd immunity that we should aspire to really get back to normal is going to be somewhere maybe 80%-ish, and we know that there's a percent of the population that's not going to get vaccinated, not going to get the vaccine or get vaccinated. But that should get us a lot closer to normal. And you can see here that we're tracking about 35%. So we've got a long ways to go, and we need to execute on the vaccination programs that have been the rollouts that have been extremely clunky to date. But that's going to be important to monitor as we go forward. Here's a quick comment on our vaccine rollout. Data that's compiled by Bloomberg just shows that it's not been a linear rollout of the vaccine, which you might have expected. In fact, it probably should have been geometric, where it's at an increasing rate as we go along. But this is very symptomatic of inefficiencies in the distribution of the vaccines. You got a lot of people that are traveling hundreds of miles to get a vaccine because there's none available in their area, even though they're in the 1A, 1B category. So, as much as you'd like to see this be a really linear kind of a line, it's not. It's been, frankly, a clunky rollout. And if we're going to get to that herd immunity that we were just talking about, we're going to have some improvements in this. And so even though the aggregate numbers you can kind of see in general, these bars are getting higher and higher, but it's up and down, and we're going to need to see better traction in this going forward. Side effects of the vaccines that are under emergency use authorization, or EUA, right now, Pfizer and Moderna. The symptoms coming out of this are fairly similar. And again, kind of speaking to the 16% or so that have said that they're not going to get the vaccine, they have a lot of trepidation. Either they're just anti-vaxxers, or they have trepidation as far as, what the side effects might be for a vaccine or vaccines that were developed so quickly relative to historical development timelines, and really the people that I've talked to that have had the vaccine, their symptoms or side effects rather are really consistent with this. Begin to talk about some economic data. The consumer sentiment 7-day moving average is what we're looking at here. As we head into the holiday season last year, we had a noticeable uptick in various things, daily new caseloads. We had increased restrictions placed on the economy, restaurants that were going to lower capacity levels, so on and so forth. The consumer sentiment took a hit. Again, it's important to look at consumers do more so than necessarily what they say. And this is kind of a sentiment number is kind of what they're saying. But good news is, if you look at the right-hand side of this, that we're seeing a noticeable uptick from where we had been, kind of this holding pattern during the holiday season. And that's a good sign because consumers represent a little bit more than 2/3 of the total economy. And then consumer growth is still really significant, and I think it's interesting to talk about some of the components of that growth. And this chart goes back to the beginning of last year. And if you kind of think about this, I mean, with the lockdowns and stay-at-home orders, and the increasing number of people having to work remote, you can imagine, under the theory that a person's home is their castle. They're going to want to spend money on that, and that's really borne out in the data here, because you've got household appliances, household for personal and home furnishings. So the whole idea that furnishing the home and spending money on the home is a very consistent theme and last year. And these represent this data here is seaborne imports by industry, and seaborne, these are container ships with large goods, essentially. The Consumer Comfort Index is here, and I wanted to show this in kind of concert with the other slide on sentiment. The two kind of tell the same thing, that sentiment in that chart is picking up, consumer comfort is picking up a little bit here. But the other thing I wanted to show in this chart is that just the fact that we're so much lower than where we were in terms of the index of consumer comfort, that there's, it's both a problem in the sense of the aggregate difference, but it's also an opportunity in the sense that we've got a lot of room for growth if the consumer is confident, if they have money to spend, and the climate is conducive for them to spend it. And I think it is. So this gives me some hope for 2021. And this is a reason why, looking at that last slide, I really want to talk about incomes versus consumption. And you can see the blue line represents consumption spending, and it's a somewhat linear line over the last several years, right? And we know that we had the disruption with the pandemic. We know that it's battled back. Consumers done reasonably well on spending, but we still are below where we were. But in disposable income, this is the interesting thing, and that's that kind of that lighter blue line. And we know that within disposable income are what they call transfer payments, and these are stimulus payments, these are unemployment benefits, and we had a lot of that last year. And in a lot of cases in the lower income cohorts, which we'll see in a second, those folks spent that money, and it really benefited us at a time where we needed consumption. Whereas a lot of the middle and higher income cohorts save that money. And typically in a recession, you do see a higher savings rate. And we certainly saw that last year. But what it does is it creates a lot of dry powder for potential spending in the economy. And I think that could manifest itself here in 2021. And this chart tells you that there's a lot of excess savings that are kind of being held in checkable deposits. And we know such things as like the $600 incremental check that just went out. I think Bank of America said last week that only 28% of it had, by their estimation, had been spent. So there's a lot of savings going on. that could drive a meaningful amount of consumer spending here in 2021. Here's a chart with data from Oxford Economics that I think does a really good job of kind of breaking down that socioeconomic data that we were just kind of alluding to. And so the green areas represent kind of the almost the middle to upper income cohorts, and these folks saved a lot of their money, and whereas kind of the orange and the red down below are the part of the population, the lower income cohorts that spent it, and you could see that as we got through the end of the year, that obviously the aggregate savings increased, but if anything, these kind of this philosophy of lower income spending it and higher income saving it just essentially got reinforced. And again, I think the higher income folks, have a much higher capacity to spend, right, and they can do so very quickly if the conditions are right. Talk about unemployment benefits, and these are initial claims data, and we saw some improvement as we got through the summer, and we began to see weekly initial claims data that was below 800,000. That was kind of like an interim feel-good level, if you will, even though the numbers pre-pandemic were much, much lower. But we lost some momentum in the labor market as we got towards the end of the year. Again, at about the same time that we saw a decline in consumer sentiment. We saw the labor market increase, or excuse me, the unemployment claims increase, and it kind of stayed higher than that level for a while. And so we were maybe a little less optimistic about labor kind of exiting the year. But good news is in January thus far, the weekly data not only did it peak, but it's now coming back down. It's still below those levels of last summer, but maybe on a very short-term basis, encouraging, and hopefully we'll get some additional traction in labor in the coming weeks. Quick comment on gross domestic product. This is the economy in a nutshell. And on the upper side, it goes back to 2015. We've shown this chart in several iterations before, but I just kind of wanted to show it again here to kind of frame, my argument that is really made down below. But that blue line in the upper part represents kind of that trend line in the overall size of the economy here in the U.S. And we were very close to 19 and a quarter trillion dollars as we came into the beginning of the year, and obviously we had we destroyed a chunk of our economy, and we battled back and we've rebuilt a lot of that, but we're still at a gap. And so the conventional wisdom is that we're going to recover that lost gap probably by the end of 2022 or perhaps the beginning of 2023, depending on whose forecast you look at. But that's kind of the conventional wisdom now. It's going to take us a couple of years to get there. Now, if you look at the bottom part of that chart, that goes all the way back to the Great Depression. And if you back out that, essentially that 20-year noise, if you will, obviously with the Great Depression, and then we had a few really strong years, and then in 1937, the Fed increased interest rates too quickly, and we fell back into a recession. And then we had the war years where this outsized production, huge economic boom. And then after the war ended, we had all that glut of capacity. So we had a lot of noise in there. But if you get from 1950 on, the incidence of a 12-month period of negative economic growth is actually fairly low, right? And so we've had some notable periods, obviously the global financial crisis this past year, and then obviously we've had other areas that kind of straddled recessions, but the overall incidence of negative economic growth is actually pretty rare, right? And so there's a strong bias of growth over time. And I think as we lapse this last year and anniversary all the issues from 2020, I think it just gives me some really strong hope for the near-term future. I wanted to spend a couple of minutes digging into another component of the economy that has actually been really strong, and that's business equipment spending and business investment overall. We know services have been weaker, goods have been stronger, certainly durable goods have been really strong, and business equipment spending has been really strong as well. So, again, when you've got the consumer that represents such a large part of your economy, obviously you want all cylinders to be firing. And it's good to see that there's at least enough optimism amidst some of the turmoil in the small business sector that overall business equipment spending is higher. Now, this is spending on items to make people more productive, ostensibly, the folks that are having to work from home. There's technology investments and things like that, and even, people at home buying stand-up desks and things like that to be more productive. But in any case, it's good to see. This is the business investment contribution to GDP growth. And when you think about GDP or the economy, they're really, I go back to the old formula, the economy equals, C plus I plus G plus X, which means consumption, investment, which includes inventories, and then government spending and then net trade. Obviously you want to, sometimes when you have your strongest economic years of growth, you've got all of those things working together. And we know government spending obviously has been relatively high. Consumer has been reasonably strong, even though we saw that, that there's been a lot of savings. But obviously we want consumer spending to be higher. But business investment growth, this is that I in that equation. And it's really good to see that that number is positive and it's actually contributing to growth. And what's not really captured in this is, I think, a real opportunity for 2021. And we showed this chart last week, but inventories are really low right now. And when you get into a point where you're facing the prospect of economic growth and your inventories are low, well, obviously the demand that would come from growth would inspire you to put idle production capacity to use to replenish your inventories that you can sell. So the fact that we've got low inventories now, and we already have a business investment number that's contributing to growth, I think lays the groundwork for a really uplifting, potentially uplifting 2021 in that particular sector. Next, we're going to look at capital goods orders and shipments. We're going to look at durable goods, this whole kind of goods sector, if you will. And we know that manufacturing has been strong. It doesn't account for a huge part of the economy, but it is important to the health of the economy. And there's some things in these charts that we could not have anticipated sitting back here watching all this stuff play out last March. And notably, on the left-hand side, you've got in blue, you've got orders, in red, you've got shipments, and both of those are tracking really high. I mean, you could not have predicted that. We were not expecting this, but that's a real strong sign for the economy that we've got momentum heading into 2021. I don't see where that's going to wane as long as you've got business confidence, which is strong, and you've got this synchronized kind of global recovery, if you will, as we're all getting vaccinated. So I see that continuing to some degree, maybe not at the pace at which we've seen it, but nevertheless positive. On the right-hand side, in the green there is the recovery time lag that it took us 5 years to reattain our prior peaks in durable goods orders during the great global financial crisis and the recession of 2008. Now that checkered, that broken line, the blue line on the far left of that represents, what happened this past year. And it's just uncanny how quickly it snapped back. It took us less than a year to reattain those prior peaks. I guess in this chart, it's called the 2020 Great Lockdown Recession and Recovery. I just call it the shock recession because it happened so fast. If you blinked, you really kind of missed the impact of it. A brief comment on housing, we're beginning to get some year-end data, which kind of gives us a full year's picture, and we'll be rolling out some of the some of the incremental housing data that we see as we get it in the chart packs in the weeks ahead. But on the left-hand side, annual new home sales. And, we know last year was strong. We know housing has been a real bright spot in the economy. But, not that, housing has not contributed over the last several years, because this chart clearly tells you that this is a continuation of a multi-year trend dating back to, basically the post global financial crisis trough. And last year was an exceptional year. And it looks like we're starting off on the right foot. If you go over to the right-hand side, the MBA Purchase Index, which is the Mortgage Bankers Association index, there's that little thick blue line, and that you can see on week 1, week 2, and we're getting this data kind of on essentially a week lag or so. And what that's telling you is that we are tracking above this multi-year trend. All of those lines is a little bit noisy there, but essentially the takeaway is that we're starting off the year in a mortgage purchase index basis, much better than we have in most recent years. Now we're going to look at some housing data for Texas, and in continuing this theme of the strength in the market, we look at the trend line, multi-year trend line in Texas home sales and single-family housing permits, and obviously you can see in this data it also has superimposed a 30-year fixed income, or excuse me, the 30-year fixed mortgage rate. And we know that with 10-year Treasury yields going down, mortgage rates have gone down, which in and of itself should help housing affordability. But we know that that's been offset by decreasing supply of housing in the market, and so you can kind of see that perhaps a little bit. But we know that 2020 was strong. We know that there are a lot of single-family housing permits, so there's supply that is ostensibly coming. It's just not here yet. So in some areas, particularly here in Central Texas, there are areas that are in negative inventory. Months of inventory are actually negative, which is it's really unprecedented. And then in that blue bar, you can see is Texas home sales. And we had a lot of momentum, but as you can see, it's beginning to crest there a little bit and kind of flatten out, and that's really a function of this tight inventory situation. And it'd be interesting to watch how this plays out over the coming months, because there is a lag between when you can translate housing permits actually into new construction that can then be sold. In a lot of cases now on new housing developments, I mean, the developers are taking bids, which is another highly unusual type situation. So you're seeing housing prices go up rather dramatically in a lot of areas. Now we'll talk about energy here real quick. And what's important in all of this is right after, literally within this past week, we've had the Biden administration terminate the Keystone Pipeline, which was going to bring Canadian crude down to our Gulf refineries, which are already, they don't have a lot of capacity, but it was going to add product into the market. And so, the idea is that, the curtailment of the development of the pipeline is going to result in perhaps higher energy prices across the board, higher input prices for people that use energy in the production of goods, and in the delivery of services, perhaps. But a couple other things to consider as we kind of head into. We got 2 full slides on this. On this one, we've got crude oil production, which has kind of stalled out here. Now, we've seen some strength in crude prices here in January, and to the degree that those are sustaining, and maybe crude prices, if they go up a little bit more, it might inspire some of this idled crude production capacity to come offline, and that number might go up, but it's clearly below the 13 million barrels a day that we saw kind of heading into 2020. But the fact that we've got flattening out crude oil production, and on the right-hand side, we've got refinery inputs, which are lower than they have been over a multi-year period starting out this year, I think could lay the groundwork for higher energy prices overall in 2021. This is a chart that kind of depicts, where crude oil stocks and gasoline stocks are. And we know last year, just for contextual purposes, that with the shutdowns and everything else, people weren't driving, they weren't consuming gas, which meant that, and then the collapse in oil prices meant that producers weren't producing. We had a glut of energy basically, and it took us a while to work through that. And the good news is here in January of 21, we are in a 5-year, we are within that 5-year range now. So what that tells me, or maybe implies here, is that we're going to have energy prices that are going to be influenced by more normal type of supply and demand features, as opposed to some of these really strange and unusual circumstances that we faced last year. I have a few words on Treasury yields, and we've got two sides of the coin here. On the left-hand side, we have the 1-month T-bill yield. I mean, these are really short rates. And then on the other side, we've got the 10-year Treasury yield, kind of this bellwether. And we know, on the 10-year side, that interest rates were moving higher. The 10 years much more influenced by inflation expectations and kind of longer term type things, whereas the 1-month T-bill yield is influenced much more so by monetary policy. And we know that the Fed's going to keep interest rates lower for longer, and clearly we've seen a downtick. The 1-year T-bill yield going down as it has is really as much a function of this massive increase in liquidity as really anything else. Now on the 10-year side, we've had a little bit of volatility in the market. January, people that kind of follow the equity markets know that January was a little choppy, and there's maybe a little bit more demand for risk aversion type investments like a treasury. And so, increased demand, prices go up, yields go down. So we saw a little bit of decrease in yield in the 10-year treasury. But what's interesting in this is that you've also had a downtick in short-term rates. So essentially, we've had the whole yield curve kind of in the last month shift down slightly. But we'll want to see what inflation expectations do. Of course, we just got through talking about energy input prices, and that energy is not a part of core inflation, but it is important to producer prices. So we want to make sure that we follow all of this. I still think the conventional wisdom has the 10-year Treasury yield, which is down essentially close to 1, maybe slightly below, might wind up at 1.5% by the end of the year. Now, I've got this chart up to kind of show um, a couple things here, a few things actually, and I thought it was interesting. It's entitled Triple C Spreads, and then X Triple C Energy. So Triple C credits are very speculative credits. These are publicly traded bonds of companies that have a high risk of default. And typically an investor that invests in something that risky would demand a pretty high yield. Well, guess what? Yield spreads, basically yields on these high risk bonds relative to more riskless bonds. There's a difference in those yields, and that's called a spread. And so usually the spreads for speculative grade like triple C bonds are much higher than where they are now. That you would demand obviously a lot more return for the risk that you're taking on. Well, that's really tight right now. I mean, historically tight. It's just uncanny how tight it is. Could not have predicted that. This is another one of those things that would have been hard for us to predict last year. And we haven't seen a rash of defaults, but we have seen them in the energy sector. And you can see that in the green line. That's speculative grade energy credits and where they're trading in terms of yield. And as we all know what happened in the energy market last year, I mean, it's quite understandable that energy spreads would be much, much higher than overall credit spreads, and that's the case, but they're even trending down. So credit spreads are really tight. The other takeaway from this, in these tight spreads is that there's a lot of people searching for yield, and they can't find it in the short-term markets or in the risk-free markets or in the, very high credit space. So they've got to stretch out and dig into these more speculative grade credits to find yield. And the more, that you demand, the more demand that we see in the market for these, the higher the prices are and the lower the yields. And that's a big input into why we're seeing these speculative grade credits yield so little right now. And so another sign that we've talked about that, we might be at a kind of a point of froth a little bit in both the fixed income and the equity markets. And I think it's just kind of, another signpost that tells us perhaps that we're in for a little bit of volatility coming up. Core inflation. This is also from the economic outlook from the Federal Reserve Bank of Dallas. This is a national number. So this data is from the Bureau of Economic Analysis. And the main sole takeaway here is that we've got we have headline personal consumption expenditures inflation, PCE inflation, which is what the Fed looks at. It's, about 1.1%, well below the 2% the Fed is targeting. And even this trimmed mean, and I won't go into that, but it's produced by the Dallas Fed. So it's meant to be something that kind of smooths out some of the extremes a little bit. It's even tracking, 1.7. So we're well below the 2% inflation rate that the Fed has targeted as kind of this longer term, average, that it would have that would be a catalyst for them to want to raise rates. So again, another signpost here that interest rates at the short end are going to remain really low for a lot longer. Mobility and Engagement Index. This is back on Texas data, although it's got in red, it's the U.S. And you can see that, from a mobility standpoint, Texas is really beginning to emerge. Actually, both Texas and the economy are beginning to perk up. But we were flatlining a little bit through the middle of the year. We were down in middle January. It looks like we're trying to emerge from that, but we still are, from a mobility standpoint, an economic engagement standpoint, we're still well below where we need to be, or certainly well below where we were pre-pandemic. This is another chart from that same presentation I thought was really interesting. So, I mean, it's talking about jobs and really this notion of structural change within the economy because of the pandemic. And some of this may seem pretty intuitive, but I thought it was interesting nonetheless. So, jobs may not return to pre-COVID levels for some different reasons. But this is a business a summary of surveys, a business report on expected permanent changes. So we know on the left-hand side, telecommuting is going to go up. That index is higher, percent noting an increase, and technology adoption, contactless product and service delivery, as well as the development of other new sleeves of revenue. And then office space and business travel are going to be down. And office space, there may be a kind of a permanent dislocation in that that we're going to have to contend with in the commercial real estate market. On business travel, like after the global financial crisis, it just took some time for that to recover, and it seems like we're going to have to contend with that being a bit of a drag for quite some time. And but anyway, it's interesting data because we've already we're almost we're within a stone's throw of the anniversary date of when the pandemic and all these lockdowns were imposed, but literally almost a year later, we're seeing some pretty hard data that tells us that telecommuting is here to stay. And that technology firms that are able to address this productivity challenge, like Zoom, et cetera, are really well positioned to benefit. All right, now we can talk about GameStop. And that was the news of the week last week. Now, this is going to require the whole mechanics of what went on with Reddit and the retail group. It really kind of deserves its own separate conversation. But suffice it to say that there are a lot of institutional investors that were betting short on a lot of these companies going belly up. And this is almost like the revenge of the organized retail investor against that institutional machine. And a lot of the institutions lost their shirt here over the last week. And companies like GameStop, AMC Entertainment that have been beleaguered, even well, in the GameStop's case, even predating COVID. You look at these charts on the left, and it's just a cataclysmic series of events that have caught the regulators' attention, frankly. And this is we've always talked about the influence of the retail investor and how oftentimes retail investors are typically naive and they're late to the party. It's kind of like some people call it the dumb money that comes in at the end to help sustain a rally, in its later stages. But, in this case, these are well organized like chat rooms and trading platforms, which are driving these stocks higher and lower and just creating more volatility overall. And that you can see that a little bit on the right, because on the top right is the NASDAQ volume, and these smaller like Robinhood and these other smaller platforms have really taken root, and the retail investor has just gone nuts lately, and you can see the volume has really spiked to an all-time record. I mean, really just out of the world kind of data, and then even on the data below, which is both of these are from Bloomberg. I mean, you just see these volume numbers go through the roof. So this is two kind of representations of essentially the same type of data, but it's breaking it down into kind of a specific category. Now, on the left-hand side is total U.S. option call volume. Now, an investor buys a call option. You own a call option if you want to profit from an increase in that underlying security that you're buying the option on. So, in other words, you buy a call option when you're bullish. Well, obviously, what this tells you is that there's a lot of bullish people out there, and it's really increased over time. So, and it's really spiked lately, frankly. Now, on the right-hand side is the retail call trading activity for, these are the small contracts. I mean, these are the small investors on the right side. And you can see that really is a lot of the impetus behind this, this more kind of this trend of total call option buying. Institutions are involved in it as well, but the retail investor is really jumping behind this in small lot volumes. And it's a sign of extreme bullishness. And I like to look at it, and we've talked about this in charts of the week before, that it could be a sign of near-term froth, basically. Volatility index here. This is the VIX. This is kind of the channel we saw in 2020. It spiked, and then we saw bouts of volatility, but volatility overall decreased. Now we're seeing a bit of an uptick. Now this is something that we expected. Not too surprising. Some of it has to do with this GameStop issue and what's going on with GameStop and AMC and some of those companies. But again, this is something that we might expect to see kind of play out a little bit over the next couple of months. Money supply is in the red. And we know that through the pandemic, we've had a huge spike in money supply. This is the liquidity that's sloshing around in the system. Now, and the black represents the slope of the yield curve. And we know that all of this liquidity that's sloshing around is, usually inflationary. Now, we haven't seen it yet. We haven't seen, for all of this increase in liquidity over the last several years, we haven't seen inflation, but this is unprecedented liquidity. This is serious liquidity in the market. And we know that the 10-year Treasury has moved higher because there's this kind of this latent notion that we're going to get inflation at some point. And I think that the trend lines here clearly suggest that that's going to be the case. I don't see hyperinflation, but I do see inflation. And I think this chart seems to kind of reinforce that notion. All right. Well, I thought I would end on a slide here that was interesting. And again, we live in Texas. I know some of you listening are in other states, but we've clearly seen a lot of net migration into our state over the last year, over the last several years, frankly. But this chart will kind of highlights the states that are losing population. Those are in the blue, and the ones that are gaining. And you can see there's kind of a basic trend towards lower cost states from higher cost states. So people are leaving California, New York, the Upper East, kind of the Rust Belt. They're going south. They're coming to Texas. Clearly, they're actually going out to the west. And so you see, Idaho, Nevada, Arizona really picking up steam in terms of net migration. I think there's a lot of reinforcing trends here that are probably going to persist for quite some time. Well, that'll do it for this week. I appreciate you spending the time to join us. At the information you see on your screen, we'd love to hear from you. Please feel free to reach out with questions or comments, and hope you have a wonderful week, a safe week, and we'll talk to you again soon. Take care.